Um, I'm going to discuss audit technique guides. These have been developed over the years, and there was a program back in the 90s called the Marget Segment Specialization Program, which basically gave the auditors um, inside information, so to speak, on certain specific industries, rather than just sending out an examiner to audit dry cleaners one day or a physician the next day. They wanted to equip their examiners with a guide that they can use. And these guides provide the examiners unique industry issues, business practices, industry terminology, sample interview questions and procedures, and other related items. So these guides can be found out on irs.gov. If you look up audit technique guides, you can find many of them. They're not all available to the public. So these guides can help an examiner reconcile discrepancies when reported income or expenses don't jibe based on the usual standards in the industry. Um, and as a result, it streamlines their procedures, makes the auditing process more efficient. Well, a word to the wise is sufficient. So some of the issues I just mentioned, one, uh, income or expenses, it's generally an expense that is rather high according to industry averages, or it could be income reported is lower than generally the average for that industry. Some of the items commonly included in these guides for small businesses, which represent about 65% of all businesses, uh, would include a discussion of internal controls, source of funds used to start the business, a list of suppliers and vendors, details on business operations, key business records for the industry, records of cash receipts and credit card charges, numbers of employees and their responsibilities, identification of individuals with control over the payroll. And so they're also looking for business funds that are used to pay personal expenses. And now keep in mind that the IRS only has the resources to audit about 1% of everyone. There's a DIF score that they use to assess the likelihood that they'll be able to collect some dollars. This is discriminant inventory function program, or DIF. So red flags are pretty much common. I've mentioned a few of them. Large deductions is fundamentally the most common DIF score element that will increase a DIF score, thus perhaps pulling your tax return for them to send you a letter or send out a notice that they're going to audit your return. Most 80 or 90% of audits are by letter. There will be about 5-10% that they will request you to show up at their office locally with expenses, usually receipts and whatnot. And of course, the more documentation you have, the better. So keep records of everything for probably 7 years for businesses. You might even consider going all the way back to the beginning of the business, just in case, because fraud cases can go all the way back, and there's a few horror stories where IRS won a case and the taxpayer wasn't able to prove otherwise. Any questions, give me a call, 303-447-1626.